Okay, welcome everyone. We'll start our lesson 2. As you couple of you know me, my name is Anjum Satha, and it's my email address. If you have any question, you can drop me email or message in the on the WhatsApp group. Yes, we'll go through accordingly. And today lesson is our LO2 learning outcome 2. Understand the appropriateness of financial reporting framework, which we'll go through. Okay, so we already discussed M of this unit. Always good to be reflect, crunch your knowledge about financial statement. You most of you working in accounts, so you already know about the elements, different elements of financial statement. Under IAS 1, International Accounting Standard 1, we prepare 4 types of financial statements: statement of comprehensive income, statement of financial positions, statement of cash flow, and the statement of chain inequity. So always under IS1, we need to prepare the financial statement, give us true and fair information about the financial matters, and we should provide the information to the various stakeholders. So today lesson is focus on the financial performance. We look around the revenue, non-current asset. We'll discuss different elements in the financial statement. That all will be in our discussion, and which we'll go through. So we have different assessment criteria. 2.1, which is assess the application of financial reporting framework, which we'll go through. First, we'll look around what is different elements of the financial statement. Financial reporting is provide the rules and policy and the guidance how we can structure the financial statement. We have an international accounting standard board which give the standards, especially for company those have multi location operation or in MNC multinational corporation. So the limited company give the owner the limited liabilities. We know the limited liability mean the liability whatever you have up to your investment. A lot of people think it's a limited, no doubt, but if you it can be unveiled the limited liability if someone is involved in fraud, and it can be claimed to the personal asset, like in term of the bounce back loan thing people have, because that's been given to the directors personal as well as the company. So limited companies may be owned by managed by different people. Limited companies are owned by the shareholders, are shareholder appointed directors, and then director have a relationship with the various stakeholders, and we need to be work in the best interest of the various stakeholders. And we always try to provide true and fair information, and our agency relationship should work accordingly. So when we looking the statements, how many we discuss, these 4 statement of profit and loss. But when we preparing under IAS 1, because only we have a few heading, because all of the can be, which we'll go through in a minute. So revenue, cost of sales, and gross profit and other expenses, we can categorize accordingly, not putting individually item to distribution costs, admin costs. And statement of financial position, we can look around non-current, current assets, liabilities. We can categorize accordingly, so provide under each section true and fair information. Okay, so when we look under IFRS, International Financial Reporting Standards, we can look around 2 years. Yes, what's happened? Our revenue, our cost of sale, gross profit. Then we have. So this is the one of the layout which we can under the IS is better to be provide 2 years figures if the company is operating. So is good to be comparative figures. We learn about the qualitative characteristic of financial statement, which we mentioned in the previous lesson. So those it need to be consistent, it need to be comparable figures. We need to be all, to give it the true and fair views about the financial statement. When we look under IFRS, International Financial Reporting Standards, which we can look around our statement under IS1. So we can go through the non-current asset, current asset, total assets. Yes. So first always we'll go through intangible asset, and then tangible asset, and these, which we'll show in the financial statement under these heading, or this layout we normally follow. Equities, liabilities, yes, always give the 2 years figures which we can, and that will help, to various user of the financial statement, true and fair information, and they can use financial statement accordingly. So qualitative characteristic financial statement should provide true and fair information. So these are qualitative. So is the relevant information fundamental characteristic of financial statement should be capable making the difference. All materiality figures should be included. Faithful representation. It's complete, neutral, and free from error information. Enhanced qualitative. Further, these are the four which we can look around. The comparative figure comparability, 2 years we can compare each year. We can verifiability when we are saying is asset where they are. Yes, how we should be verify them. Timeline, which is 90 days after the year end, must be published the information, and the information should be understandable. Understandability should be as the person, those who have a basic knowledge about account should understand. So always in the notes, in the financial reports, we should provide these notes, because a good explanation, the people can understand where these figures came from. You can even the segment reports, segmentation reports of different product, different brand, what they have, what sort of the profit or loss we earn. So that's all we can show, and that is very crucial to show. Okay. Depreciation and the recognition, we can look around the property, plant, equipment must be depreciated. Useful life, the only exception of land, it's normally has indefinite, life, which we can look around the land. Of course, land not depreciate, but the building need to be depreciate. We should do the proportion of it accordingly. Depreciation amount, of course, cost, the fair value, which we discuss under IAS 38. Impairment and impairment losses we mentioned in the previous lesson, which we can residual amount. IAS 16, property, plant, equipment, that's coming, the depreciation and property, plant, equipment are the item which we need to be depreciation, and the disposal of the asset, review the depreciation should be reflect accordingly in the statement. So disposal of the asset, if the asset being disposed, it should be either we have a gain or the loss we make on the asset which we dispose, we should show accordingly in our financial statements. Okay, so please, if you have any question, you can ask. Okay, so irrecoverable bad debts, always any bad debts which we can't recover, it should be adjusted in the financial statement, and we should provide, because that is very crucial to show all these facts and figure true and fair. Irrecoverable, we can't recover, or we are creating the allowances for doubtful debts, and we'll make adjustment accordingly. Okay, we know accounts always we prepare accrual basis, not basis of the cash, because we do accrual accounting, matching concept. Each year income and expense should be matched under that year, and we can look at an accrual and prepayment adjustment. So if we have accrued expenses, so this slide will indicate, if we have accrual of expenses. So because the first place we record, we should record as a expense is a debit, and accrual expense mean the expense incurred but we not being paid yet, so we can do credit as a liability in the statement of financial position. Prepaid expense we do because the first place we record as expense, like if you paying car insurance, so we do the debit the insurance expense and credit the cash if you make the payments. And when, because the expense is not happened yet, is a prepaid some element. For suppose you bought a insurance on the 1st July, your account closed on the 31st December, so it's 6 month prepaid, 6 month is expense, so we can proportion accordingly. And we can look around the decrease our expense. What first place we record as expense, we did debit, now we're doing credit, and the prepaid will be as a debit, because prepaid is an asset, and asset shows under the uh, statement of financial position. Any question, please? If you have, you can ask. Okay, then exactly the statement, the adjustment in the income which is means sales, accrual income, which is opposite than expense. So accrual income mean you have received the money, like you builders, you not provide the services, you can't treat as a income yet because you not provide the services, not sale being done. So we can do first place you did the debit the cash and credit the sales, but now we need to reduce the sales, so we have to make adjustment accordingly if we have, so we can look around accrual income, and we can make the increase in our asset because the asset is receivable because not being those, we can make adjustment accordingly. Prepaid is mean advance paid, and accrual mean provide services but not being received yet. And prepayment is mean advance, advance you receive. So we do first place we record as a sale. Now we reduce it because we debit the dr mean debit, because normally debt click debit and credit rules, couple of you of course very well knows. We can make adjustment accordingly, and that's because it's your assignment based course, really no exam, so we need to be just adding example, that will be absolutely fine. Okay, so we can look around. When you do are making adjustment, always draw the timeline when my year start, when my year finish. So accrual and prepayment make adjustment accordingly in the book of accounts. Okay, so this is a summary when the expense, when the income, when we have in term of, so how we can adjust and which statement need to be adjusted, as we mentioned in the previously. If the accrued expense is a liability, the debit the expense and credit the accrued expense. And when is the income accrued is asset, debit the asset and credit the income because it's income and but not being paid, and is the expense, so prepaid can be debit the prepaid expense and credit the expense, so we can make adjustment accordingly. Prepaid is a liability if the income, so we do debit the in the profit and loss as, and we credit the liability because the prepaid income is the liability because the prepaid adjustment you different sometimes of original. Okay, so we have accounting standard boards which help to look around these financial statement. Sorry, I think so, maybe just one sec. Okay, so we have international accounting standard board set the standard financial reporting, the scope of the framework, the objective of the financial statement, qualitative characteristic, recognition criteria, all these need to be, because main purpose is true and fair information to the user. Okay, then the framework identified two underlying exemption: accrual basis accounting, also known as a matching concept. Always we need to be faithful representation, complete, neutral, free from error. That's the faithful representation meant by, we can't, yes, 100%, but we looking within the law, within the parameters, as according to our intention, not to make any hidden things. We'll give the true and fair information according to the conceptual framework. Okay, so true and fair under IS1 state in the financial statement, international financial disclose the facts and figures, international financial reporting, not misled information. And we know the four types of financial statement should be prepared and should be provide the true and fair information. So there can be various user of the financial statement, interested parties can be, so user of group, equity investors, existing lenders, implies stock market analyst, and these the user of financial statement and stakeholders, we need to be meet their expectation. Okay guys, so we've been given one of the financial statement. So in the, if you want to measure the financial performance, we use the financial ratios to measure it. And to measure the financial performance, we pick two companies, and we look their gross profit. Gross profit divided by the sales, or we call turnover. So one company came at the financial ratios 45%, other is 52%. Operating profit, so Anika is 9%, other is 11%. Gearing ratio is, gearing mean is a high gear, high risk. So debt divided by debt plus equity, so 13.25. So debt is mean the non-current liability, and debt plus equity. So because sometimes we can borrow money, but we investing into for non-current assets. So that's why we just want to make sure we look those. And those because Papika have 71%, and alternative formula can be your debt divided by equity 15 and 245%. So which one you think will invest, and which one perform better than others? Yes. So that's we can, according to the gross profit, is Papika is better. According to operating profit, is Papika is better. According to the gearing, which is Anika is better, less risky, because low ratio is better because it's a gearing, high gear, high risk. And this based on, and we can look two more interest cover ratios. So we can say profit from operation divided by interest paid. So 11.8 times higher our profit, and 3.1. So Nika is more established company compared to Papika is 3.1 times their profit is higher than the interest. And asset test ratios, we call current ratios or quick ratios. So current asset divided by current liability, and more quick ratios, we take out inventory, because the inventory is not most liquid, because sometimes inventory can be outdated and is coming, because normally benchmark is 1 to 1. Yes, £1 worth of asset, £1 worth of liability. It can be varies industry to industry. So in a list can use, and we can. So according to these information, which we calculate by looking the financial statement, and we can draw the decision. So we can compare the company performance, compare the current period from the previous period, and we can do different analysis, look the weaknesses of the company, and we can look around at the, yeah, we can horizontal analysis, vertical analysis. We can find the industry averages, the benchmark to measure the performance, not the ratios itself, but interpretation of the ratios is more important. Limitation of the ratios we need to be look around. Okay, so then the company can make the strategies, and the strategy need to be designed accordingly. There is a model called balance scorecard, BSC. Which model? BSC is a balance scorecard. So please, if anybody any question? So which is given by Norton Kaplan, author. Yes, it's quite good. If you look around BC, is called balance score called model. Yeah. So where we can look around different perspective of financial perspective, research and development, internal learning. These are all the perspective we can look around in that, then we can make the decision, not only the financial ratio itself, because the ratios can be before COVID, after COVID, or during COVID can be totally different. So always look around the user of financial statements, what sort of information they're looking, that will help them to make the right decision accordingly. So we can help to determine whether to buy or hold. Potential investor help, and the lenders which we can look around these, that will help to make the right decision. And according to our analysis, we discuss, Papika is better, Anika but overall decision is we invest in Anika compared to Papika, because Papika is a more risky company. In according to the beta risk factor, high the risk, high the return, but the return is little higher compared to the risk. So that's why we preferring to be go for Anika instead of Papika to be invest the company, and we can draw the decision. Okay, so please on your our Moodle page, we have a handouts. It's called Osborne activities, which we have a chapter 6 of that, and 6.3, 6.4 activities we can do, and with the answer sheet have as well. So you have a chapter activities and answers for those activities, so you can compare the ratios and you can make the decision accordingly. Then we included the link for further reading, so please you can copy those links and you can look around for further. And we have a chapter of the books, our books, which is available on Moodle page. Anybody, any question, please? Any question? Yes, no. Okay, so today lesson we discuss about how many types of financial statement, role of framework, and we discuss about financial performance, how we can measure it based on 4 types of financial ratios you can pick off, and we can make a decision. But we not look only the financial ratios, we look the financial and non-financial information, and the basis of this we can make the decision either to invest or not invest in certain company. Okay, that's all from my end. Any question if you have, please?
I'm okay.
Thank you. No questions.
No question. Okay, brilliant. Okay, thanks for attending today's session, and which will go through next lesson, our LO3, and then yes, we'll carry on doing 1 LOs. So most of you working in accounts, stuff, so just a matter of, and during our assignment discussion, we'll spend more time and we'll look, deeply how we can prepare the assignments, because, according to the learning outcome, we'll pick more examples. Thanks for attending and have a lovely weekend, and we'll speak to some, maybe tomorrow.
Thank you.
All right. Bye-bye.
Thank you. Bye-bye. Thank you. Thanks, everyone.
Thanks.
Thank you.
Thank you. Bye-bye.
Bye.